What I'm going to cover with you is my crystal ball of where the markets are headed in the next 1, 3, 5, and maybe 10 years. So for those trying to commercialize ideas, hopefully this gives you a better understanding of the landscape you're launching into, and hopefully this will also provide some food for thought on untapped areas, and then specifically we'll drill down into distribution models, business models, and I'll end a bit with some of the wisdoms on fundraising tips from VCs, okay? So with that, just do the real quick brochure where I blitz through this. Norwest Venture Partners, we're one of the longest running venture firms. We've been around since 1961. So what are the near-term opportunities in the short term here? All right, so we know the markets are pretty much in the gutter right now and that moods are pretty bad overall. Question is this 2002, which is the original nuclear winter following the dot-com burst all over again, or is this a more systemic nuclear winter? I think you'll get views that argue both sides of the fence, meaning, okay, this will only last 1 or 2 years. There's other pundits will say, look, we're in for 10 years worth of hurt. One thing that is unavoidable, I think, at least in the technology and the media world, for startups and entrepreneurs, you're dealing with a battlefield that's really characterized by a dance of the elephants. And what I mean by that is you have large established companies ranging from Cisco, Nokia, Google, Amazon, all scooping up more and more parts of the landscape, getting into areas you never thought they would before. Cisco getting into the living room, making game-related investments, acquiring social networking companies that might give you some clues on where they're headed. Nokia acquiring Navtech to own map data. So as a startup, your job is to figure out, as a little ant initially, how do I avoid getting stepped on by the big elephants? Or if you're even more clever, which elephant's back do I ride on to go into market and perhaps help with this consolidation battle? Okay, I say collision of the elephants also because the elephants are starting to swallow each other. We just saw this with Sun as well as Oracle, and we're going to see continuation of that trend. I would dare say that Yahoo, one of the first internet pioneers, probably won't be a going concern in less than 3 years. Think about that. Company's 10 years old. Giant of the internet pioneer probably won't even be around pretty soon as its own entity. Okay, so that tells you the turmoil going on. Some key themes you're going to see in the next couple of years that I've been looking at. For entrepreneurs, the last couple of years in growth markets, entrepreneurs tend to look at the top line, things that fuel growth, things that fuel new revenue, things that fuel new user adoption and increased install base. In recession times, people tend to focus on the bottom half of the P&L, meaning profits. What cuts out cost, what increases profitability. So it's something to think about, especially if you're thinking about perhaps selling to the enterprise. For the enterprise, instead of trying to say, give them a new productivity solution, which has very soft benefits, you might say, look, instead of a vitamin, this is an aspirin. You hear that phrase a lot. Give me a painkiller, not a vitamin. Vitamin is like a fluffy productivity tool, which has hard to quantify gains. A painkiller says, look, I'm going to cut 50% of your OpEx out. I'm going to virtualize your servers so that you can get rid of half your servers or storage backup tapes or whatever it is. That's an example of focus on the bottom half of the P&L. Second, an ad model is a very fast track to the recycle bin. Used to be, last 3 years, every business plan I had, on the revenue slide, business model slide, it said advertising, and then people would kind of buy into that. But I think from some of the presentations you've heard, that sentiment has changed. These days, if it says advertising, I will hit delete and not even take a second look. The funny part, though, I think we'll cover this a bit more. Virtual goods and microtransactions has become the new ad. So these days, I see virtual goods as the revenue model for everything. That has its own challenges, which we'll get into as well. One thing I wonder about is what happens when we saturate the market and every ad campaign is a playable game or ARG. You might have issues there because then you're fighting for people's attention. What could be very good, though, for that area is I think that will be the future of free-to-play gaming. So with a gaming model, you'll wrap sponsorships around that experience. But the other half of the equation is ad as transaction conduit, and that is going to drive towards commerce. The job of the community or the technology entrepreneur is to figure out the intention point of the audience. That's when that audience member is the most valuable. Quick example, the reason we were able to get Sidestep acquired by Kayak for $200 million is because they were the best at monetizing travel searches. They had a little plugin into your browser and it was always scanning. It knew when you search for an airplane ticket and would immediately pop up the sidebar and say, hey, wait, before you buy that ticket, 5 other vendors will give you that same flight for 20% off or whatever it was. The point was finding point of intention is the most valuable a user will ever be. Okay, just a quick framework for you to think about. If you are not in the market for car ads, you're going to generally tune out every automotive ad you see. When you start thinking about ads, suddenly, do you notice you get very, very hypersensitive to all the car ads that pop up? That's the beauty of technology, and what I think the power of social media can do is better dig up those points of intention for purchase. All right. Mobile, pretty soon everything that's online will be mobile and vice versa. So mobilization technologies to mobilize a social network will be out there. Twitter feeds, those sorts of things will be pretty important. MTX stands for microtransactions, so being able to sell virtual goods. And then sort of the gamatizing of media, if you will. It was kind of funny, somebody said before, gaming didn't used to be cool before. I will quote a LA media friend of mine from the Hollywood scene. He said, "Man, I used to say I was from gaming before. You couldn't get laid to save your life if you said you were in gaming 5 years ago. These days, every single big media company is out there trying to make a game acquisition because it monetizes better than traditional advertising. So they're all jumping on the bandwagon. Something to look about. And you've heard the phrase social gaming, which is the intersection of social media with gaming. All right, so how do you drive adoption and addiction? And to this point of virtual goods, how do you make somebody buy a virtual good, okay? It's all and well to say, my business model is virtual goods, I'm gonna sell virtual currency. But it's not just something you bolt on. You can't just slap it onto your service and expect people to buy it. The idealized framework that you've heard people say before is that social media serves Maslow's hierarchy of needs. If you've ever heard of Maslow's hierarchy of needs, it says that there is basically a pyramid of basic human needs, starting from the need for shelter and food, and then goes up through love and safety and all these other self-actualization areas. And people use that in the context of motivators for social media. I think that's almost there. I'm a little bit more pessimistic being a capitalist, so I flip it upside down and I call it basically the Dante's Inferno of 7 deadly sins. So this is, joking aside, this is actually a very useful framework for you in designing a microtransaction flow or anything to do with virtual goods or virtual currencies. There is no social media service that shall be addictive that does not tap into one or more of the 7 deadly sins, directly or indirectly. Let's give some quick examples. Pride, MySpace. Look at the bling on my page. Actually, a shift towards what people call capital efficiency. Can you do more with less? Instead of companies that are going to require $20, $30 million to get to market, investors want to see stories that they can test it. Can they make something that might work on 2 to 3 million? So you're going to hear a lot of investors perhaps brighten up if you say, you know what, we're going to be able to test the market and see if this thing works for only 3 to 5 million, not 30 to 50 million. Now that sounds great and all, but this has elicited another response from entrepreneurs, which is try to mini-size everything. So rather than supersize, you kind of micro-size. I only need 500K, but the issue is the reason the investor, phones aren't ringing off the hook, calling you back, is because sometimes downsizing the capital requirements means you're going for smaller scale outcomes. If you raise $500,000 and end up building a $3 million company and are kind of capped within, let's say, $3 to $10 million a year of business size, it's very hard to imagine how you can get a $1 billion exit out of that. And so you may say that, wait a minute, I told the VC I'm raising less. Why aren't they investing? Because it might have been that you just turned it into a smaller scale outcome. This is a tough conundrum for entrepreneurs, and I don't have a magic answer for you. In fact, those I have a lot of sympathy for are folks out of hardcore sciences in semiconductors or systems and telecom infrastructure. You can't build a capital efficient semiconductor company. You can't say, here's $2 million, go build a semiconductor company. Even if you're in China, it generally takes 40 to 60 million plus to build a semiconductor company.